The Kwak brothers are making a big mistake when it comes to their real estate investing strategy. Now, don't get me wrong, I'm not hating on the Kwak brothers. I love their content, I love their channel. They have a lot of great, unique information that I can't find anywhere else. But on their latest housing market information, I saw them make a rookie amateur mistake. And I want to make sure that you guys don't make the same mistake too, so that's why we're going to clarify exactly what that mistake is here. They said that they're not buying houses right now and that they haven't bought houses since 2017 because they're worried about the market crashing. Now, let me clarify why that's a mistake. Pros look to do the same thing that the Kwak brothers are doing as well. You're always looking, pro investors are looking to balance out two risks: the risk of losing money and the risk of losing out on the opportunity to make money. You have to appropriately balance the two. Now, the strategy that the Kwak brothers are using to balance the two is the rookie mistake. They're looking at the market top down and letting that make the decision for them, as opposed to looking at the market bottom up, which is what a pro investor does. So now let's clarify exactly what that means. Looking at the market top down means you're looking at the macroeconomics. When you're seeing, okay, it looks like prices are too high, there can't be any good deals, I'm just not even going to look, I'm not even going to buy, I'm going to just sit and wait for the crash. That's what rookies do. And guys, I'm not just coming up with this information out of the sky and just making stuff up. This is information from pro investors like Mark Howard, who writes books on mastering market cycles. You can find this information in his books, in his videos, in his memos. He always talks about looking at the market from bottom up to help you balance that risk out of, oh, should I be stacking up on investments, or should I be kind of preserving my capital and taking a more risk-friendly approach?
Sometimes, but it's often a bottom-up thing. See, because it's not like, well, you find a bunch of investments and sometimes you decide to go heavy and sometimes you decide to go light. What it is that sometimes you find a lot of great investments and they tell you that this is a time to load up the boat. And sometimes you can't find any bargains and they tell you this is a time to be defensive. So it's not an independent decision, you see. Now, a lot of people make that decision top down. They look at the macro, they look at the technical and all the trading numbers and all those things.
So what you need to do in order to look at the market from bottom up is you go out there and you look and you see, can I find any good deals? If you can find good deals, it doesn't matter if it seems like prices are going up like crazy. If you're finding good deals, that's a sign that the market is telling you now is the time to load up on deals. If you can't find any good deals, well, that's the sign that the market's telling you now's not a good time to buy. You should be a little bit more risk adverse. So I'm not saying that now is the time to buy. I'm just saying that their reasoning for not buying right now and in 2017 is wrong, right? They're basically banning themselves from buying. Let me give you an example of someone who's doing it right. Minority Mindset. He's also not buying right now. But I'm not making this video about a rookie mistake that he's making. Because if you watch his video on why he's not buying, he specifically says, I'm not putting a ban on myself for buying in 2020. I just can't find any good deals that meet my criteria. Now, if Minority Mindset holds true to that, and let's say he was able to find a good deal that meets his criteria, then he would buy it. That's what a pro investor does. See, all the sheep, everybody is waiting on the sidelines and waiting for the market to crash. And this is why it's important to look at the market from bottom up, because no one's considering the pain, the possible risk that you're losing out on by sitting on the sidelines. I'm just going to play devil's advocate here. I'm not saying that this is going to happen. I'm just playing devil's advocate. But let's say you sit out on the sidelines and you're just stockpiling cash, waiting for the market to crash. I know the Kwak brothers said, hey, they think it could turn in 6 months. I've looked at what economists are saying. There's no sign that the market's going to crash in 6 months. But let's play devil's advocate here. Let's say that you sit on the sidelines, you've got your cash stockpiling, and you're waiting for that market to crash. Well, the Fed just announced that they're no longer targeting 2% every single year for inflation. They are now targeting an average of 2% inflation every single year. So let's look at what the impact of that's going to have on this person sitting on the sidelines stockpiling cash. Well, since interest rates are much lower than 2% right now, we're at like 1.8, 1.5%. If we want to average 2%, we're going to expect interest rates to sort of go above 2% in the next coming years, 2.3%, 2.5%. And we can expect pretty much low interest rates and high inflation probably for the next 5, 6, 7 years. So what does that mean? That means we're not going to see interest rates go up all of a sudden. We're going to continue to probably see housing prices go up if the employment market's able to come back. And if that happens, the people staying on the sideline, well, the inflation is going to eat up their cash, and the people who have assets now are going to gain all of that appreciation. Now, of course, the markets could still crash because the unemployment has a big impact on this. If forbearance ends and people still don't have their jobs back, yes, we can see a big crash. But again, I'm just playing devil's advocate here. If you don't invest now, I mean, there's still that possible risk that inflation is going to eat up all your cash and you're going to miss out on those appreciation gains. And again, the pro investor is always looking to balance those two things out, balance the risk of losing money with the risk of losing out on opportunity to make money. So guys, if you liked the video, comment, share, subscribe, and I'll see you in the next one.